we've got a host of different companies, different industries. We've got some listed companies as well, for whom the B status reporting for the commissioner is quite important. We've got a number of B verification agencies on board as well, and it's always refreshing and good for us to share knowledge and understanding. And I think particularly today with the net value discussion, it would be very welcome to also get some understanding and input from the verification agencies. Just to introduce ourselves, my name is Eric Ackroyd. I'm the CEO of Alternative Prosperity Advisory and Products. I'm also a transformation and ownership specialist. And joining me as a host is Anton van Geest. He's a transformation and ownership specialist as well with Alternative Prosperity Advisory and Products. And then we have a guest speaker, Trevor Chandler, who will be talking us through the mandated investments and the B compliance reporting around mandated investments. Trevor is our chairperson at Alternative Prosperity and has also served for a long time on the Financial Sector Transformation Council. Just a few housekeeping matters. Your microphones are muted, so for any questions and answers, if you could use the Q&A button on your screens. If you look around, you'll find a Q&A button. As we go along, please pop your questions on there. At the end of each session, we will cover the Q&A and we will answer and go through the different comments and questions. Our videos will be off today just to speed up on the bandwidth, and the presentation as well as the recording will be available afterwards. So sit back and enjoy the presentation. The topics we're going to be going through is, firstly, why is black ownership relevant? And what is the relevance of black ownership? Where does it impact on the code? What are the key thresholds in terms of what level of ownership should a company consider and target? We then go through the B Commission reporting. This is particular to listed companies, but it's also applicable to organs of state, public entities, and SETAs. There's a new explanatory notice that is effective on the 1st of April that deals with this compliance reporting, and we'll touch on that notice. We will also discuss what to do or what are the implications if you don't have information available. We'll run through the JSE Share Hub, a recent solution that they've launched, and then we'll talk through mandated investments and how does one deal with reporting mandated investments in this B compliance matrix. I'll then hand over to Anton. Anton will take us through net value, and whilst it's quite a complicated topic, Anton is going to set it out in very simple terms and take us through the calculations methodically in order to gain a full understanding of that. And then on the COVID-19 impact, Anton will talk to us around that, and it will just discuss how does COVID-19 impact, what does it do to a scorecard, and what can you do about that. Right, the relevance of black ownership. Firstly, black ownership finds its objective around the B Act objectives, and the B Act is very clear in its objectives that it has the increase in black ownership as a key objective of broad-based black economic empowerment, and also meaningful participation in the economy of black people. So therefore, to have black people not only owning shares, but that they actually act as active owners or shareholders of an entity where they hold the shares, participation in board meetings, voting, exercisable voting rights. And the B Commission is very much looking at this meaningful participation when they are evaluating B transactions. The pillars that really push black ownership are the preferential procurement scorecard, where firstly your B procurement spend relies on black ownership. The reason, therefore, is that your ownership scorecard has 25 points that are allocated to Black ownership. And therefore, ownership does have a big impact in determining your BE status level, which determines the BE procurement spend that a supplier contributes towards a measured entity's actual procurement and their overall scorecard. The second area is around net value, where the net value sub-minimum threshold determines whether a company is discounted by a level, and this impacts on the BE procurement spend. So therefore, we can see that the ownership scorecard and the net value threshold impacts on BE procurement spend, and therefore it is very relevant to the overall BE scorecard. Also on the procurement scorecard, you've got the 51% Black owned supplier measurement category. So Black ownership is relevant to that. Black women ownership is relevant to the 30% Black women ownership category. And then we've got the 51% Black designated group supplier measurement category that adds 2 bonus points to the procurement scorecard. Another area is enterprise and supply development. So the enterprise and supply development scorecard also relies on the 51% Black ownership criteria for a qualifying enterprise and supply development beneficiary. And therefore we can see that Black ownership has a big impact on the overall scorecard and is very important in order to get a good BE status level. Looking at the overall procurement scorecard, I've indicated in red the areas where Black ownership has an impact. So it's not only on the 11 points for 51% Black ownership or the 4 points on Black women ownership, but it is also on each one of the measurement categories where your BE procurement spend is determined to a large extent by Black ownership. And then also, if we look at the designated group suppliers, we have we've got the BE spend, the BE procurement spend, that is the weighted spend we've discussed, but you need 51% in total on designated group suppliers. Important to note is that the procurement scorecard adds 27 points to the overall scorecard. The procurement matrix that I'm reflecting here and the BE status matrix, this is where we say, fine, depending on the number of points that a company has achieved, we determine the weighted spend. And this is the matrix whereby the Black ownership points, the overall BE scorecard points, would, for instance, determine that a company has, as an example, 77 points, and that determines their 80% procurement recognition. And we can see that the ownership points that I'm reflecting on the scorecard over here, the 25 points that make up in the scorecard, are very relevant to the overall BE status. And important to notice here is also that the procurement element is the element that adds most points to a BE scorecard. And a lot of those points are determined by Black ownership. So if we take 25 plus 27, we're on 52 points out of the 111 that is driven by Black ownership, and then also the 15 points, the 10 and the 5 for enterprise and supplier development that are also dependent on Black ownership. It is not only Black ownership that is important, but it is important what that composition of Black ownership is. In other words, who owns those shares? And if we look at the scorecard, we've got different categories of measurement, which measures Black people, that being male and female, and it particularly measures Black women in the voting rights and economic interest areas. So Black women ownership, very important in order to get a full scorecard. And then we've got the designated group suppliers. Now that measurement category looks at employee schemes, broad-based schemes, but also Black designated groups who are unemployed, youth, disabled, people from rural areas, and military veterans that make up that particular category. We then also have Black new entrants, and these are people that have not held equity instruments of more than 50 million. So it's catering for your new entrant, a new participant in ownership transactions. So the key message here is that Black ownership is important, but the composition of that Black ownership is also very important because of the composition of the Black ownership scorecard. The concept that I would like to just demonstrate or illustrate is that of the modified flow-through principle. The modified flow-through principle is applicable to voting rights of Black people as well as economic interest of Black people. And only in those two elements can we apply the modified flow-through principle. And the reason why I'm talking about the modified flow-through principle is because it has a bearing on the level of ownership that one would want to sell, or determining just how much Black ownership do you want to sell in a company. Explaining the modified flow-through principle, the picture that we're depicting here is an example where Mr. Black owns 60% in company A. Company A owns 30% in company B. When we apply the flow-through principle, we say, fine, let's take the 60%, multiply by the 30%, and we get to an 18% flow-through Black ownership. The modified flow-through principle determines that once in an ownership calculation, where there is at least 51% flow-through Black ownership, we can modify that and deem that to be 100% Black. So in this example, we can take the 60% and we can round that to 100%, multiply it by the 30%, and we would get 30% Black ownership on the modified flow-through principle. So this is of relevance, as I mentioned, when we look at the different types of threshold that we can get. And looking at the previous scorecard here, the target is 25% on the modified flow-through principle. So in our example, we can sell only 60%, but we can count 30% on the scorecard against this target of 25%. And in that example, we have only sold an effective 18% Black ownership. And that's the impact that the modified flow-through principle has. Some concepts that I would just like to define. Firstly, the 51% Black owned that we have on the scorecard. So the procurement spend on 51% Black owned suppliers for 11 points on the scorecard. That is not just 51% Black ownership. That is a status that a company achieves, and either they do achieve it or they don't achieve it. So a company is either 51% Black owned, and the certificates depict either a yes or they are not, so they are no. And that status means you've achieved three things. You've got 51% economic interest, you've got 51% voting rights in Black hands, and you've achieved all the net value points calculated in accordance with Statement 100 in the codes. Now, 30% Black women owned is a similar concept, but it is where Black women hold at least 30% exercisable voting rights, at least 30% economic interest, and the full net value points have been achieved as well. So only where a company achieves that status can they be counted in the procurement scorecard measurement categories for 51% Black owned suppliers and 30% Black owned women suppliers. The definition of 51% Black designated group suppliers is firstly that this company is 51% Black owned, and it is 51% Black owned by a defined group, being a Black designated group. And these could either be unemployed Black people, that are not attending or required by law to attend an educational institution, or they are not awaiting admission. It could also be youth that are under 35 years of age, or Black people with disabilities, people living in rural and underdeveloped areas, or Black military veterans. So any of these or a composition of these will qualify as Black designated group suppliers. Looking at the relevance and the thresholds of Black ownership, a company could have different targets depending on what they would like to achieve. And the first threshold is that of 10% Black ownership. The reason for this being a threshold is that it is 40% of 25%. And that being the sub-minimum, the 40% sub-minimum for net value. There are two calculations for net value. Anton will run through them, but the net value is always the lesser of these two calculations. And the relevant calculation here is that your economic interest divided by 25% needs to be at least 40%. And therefore the 10, which is 40%, is a relevant threshold for companies in terms of their Black ownership. The next threshold is the 12.5%. Now, when we apply the modified flow-through, as we've illustrated, we can round A51 up to 100. And by example, if we've got an SPV that owns 25% in a measured entity, and that SPV is 51% Black owned, we can round that 51 to 100, and we can multiply it with a 25. And on the measured entities ownership scorecard for Black voting rights and Black economic interest, we can count that 25 that has been calculated using the modified flow-through. But the effective Black shareholding will only be 12.5, which is 51% of 25%. And hence this flow-through, the 12.5% is relevant in terms of a threshold. The next threshold is that of deemed full 25% Black shareholding as per the targets on the ownership scorecard and on a flow-through basis. So this just being a flow-through target, we can still count the Black voting rights and Black economic interest on the modified flow-through basis, but a following target on that would be the flow-through basis for 25%. A next target is that of 30% Black women-owned. And the reason for this is, as we've illustrated on the procurement scorecard, where there is a particular measurement category for 30% Black women-owned companies. Following on that is 51% Black ownership using the modified flow-through principle, and then 51% Black ownership on the flow-through principle. And this is particularly relevant for your level 1 or level 2 enhanced recognition qualifying small enterprises and EMEs, exempted micro enterprises, where in order to be able to do that affidavit, you need to apply the normal flow-through 51% Black ownership. The 100% Black ownership, that is relevant to a level 1 QSE or EME, also a flow-through basis. So that being a relevant level of Black ownership. So depending on the objectives of a company, they would elect at which level would one like to target your Black ownership. We're just going to run a poll quickly. The question is, what is the Black ownership percentage of the company that you work for or that you own? And we've stratified it either as 0%, between 1 and up to 10%, greater than 10 up to 25%, or greater than 25 up to 51%, or more than 51%. So Sean will be running our poll, and if you could please just respond to those multiple questions.
Thank you, Eric. We're running the poll in the background. We're getting some answers in. I will publish the results in a second, yeah. So everyone can have a look. All right, everyone should be able to see the results of that poll. Eric, so we are 12% of the poll, 11% now is 0%, greater than 0 and less than 10% is 0 as well. Greater than 10% and less than or equal to 25% is 33% of the attendees. Greater than 25% and less than or equal to 51% is 9%. And we've got a big 45% of the attendees saying greater than 51%.
Okay, so I think that's very interesting results. We would normally expect that we would have quite a number of companies at 25%. I think a lot of the qualifying small enterprises and exempted micro enterprises are sitting at least 51% black ownership. And then listed companies, depending, there's a wide range of black ownership for listed companies. But very often we see listed companies between 25% and 51% black ownership. We've got quite a number of B verification agencies with us today, so I think that also probably pushes up the black ownership results that we've seen. I'm going to talk us through the B Commission compliance reporting. As mentioned, this is relevant to listed companies. It is relevant to SETAs, to organs of state and public entities. I think in our audience today, we've got mostly listed companies that are present. Now, firstly, the explanatory notice that is effective on the 1st of April of 2021. It is not a new concept. The requirement to report finds itself in Section 13G of the BEE Act, the amended Act, and it also finds its way into the regulations, and the regulations determines that the BEE Commission can prescribe the format and the manner in which this reporting happens by way of forms. And if you go to the BEE Commission's report, or rather their website, you will find different forms, in particular a form BE001, which is the relevant template to be completed. And there's also a matrix form that needs to be filled in, which is the format of reporting and contains a lot of the aspects that are now also detailed in the explanatory notice. There were also 2 previous explanatory notices dealing with that, dating back to, I think it was 2017, and then I think another one in 2018. And with each one of these notices, there's a bit more that has been added to them, but they effectively say the same thing. In the notice, it stipulates that for ownership, we are available, or we should be reporting race, gender, age, and also location, where people live in terms of their geographical location. So this information needs to be reported for all the shareholders. Also, that what needs to be reported is dividends, and the dividends declared needs to be reported, as well as the method or the formula of this distribution and the calculation of the dividends. Now, there are a couple of things that complicate this reporting, in particular where we have flow-through ownership and there's multiple levels of ownership, holding companies, and with the listed companies, you've got mandated investments that's got to be reporting. Trevor will take us through that. There are trusts that need to report. So it can become quite a complicated matter. The matrix that needs to be completed consists of the different columns. And if I talk from left to right, the first or the second column says percentage for each category. And that is your percentage by measurement category. So let's say, for instance, you've got exercisable voting rights, and that is 35%. Then you've got to go and break down that 35% and say, of that 35%, how much is African, colored, and Indian? And the sum of that should make up your 30% exercisable voting rights. The same with gender. You've got to take that 30% and break it up between female and male. On the next column on age, yeah, one's got to say what percentage of my shareholders are 25 years old, what percentage is 26-year-old, what percentage are etc. 35-year-old. Now there's no accommodation made for stratification here, which implies that one needs to go and age your entire share register. And also your shareholders, company shareholders, and trusts that hold shares in the company, or that has a flow-through shareholding. In terms of location, the requirement is to go and per province go and state how many shareholders live in each province. And then one's also got to go and report on disability, what the female and the male percentage is of your disability. Now, what happens if you cannot report? The first stipulation in this guidance note or explanatory notice is that where you do not have, or you have not claimed black women shareholding, then you write a 0 at black women shareholding, because you have none. Where you have claimed black shareholding, black women shareholding, but you don't know what the percentage, well, what the breakdown is. Or let me rather take a different example. Where you've done black designated groups, but you can't identify your disabled employees, or rather shareholders, then you are in contravention of the Act if you cannot report accurately and stack up the numbers to your BE scorecard and your BE certificate. The implications of submitting a report that is not accepted by the Commissioner is that you would be in contravention of the Act. And the Act defines offences and penalties. And if you are, it also empowers the BE Commission to come and meet with you and investigate your report. And that could lead to a longer investigation and a misrepresentation matter that the Commissioner could raise. So it is important to report accurately and to have a complete set of data that you can report. The BE Commissioner summarizes these reports annually, and they then produce a report on the state of transformation in the country. And this information feeds into that report as well. But what we are seeing here is that the Commissioner is using the compliance matrix reporting to really make companies validate and go to the most detail in terms of stacking their ownership together. The JSE has developed a solution called Share Hub, and this solution is a tool that listed companies can use to communicate with their shareholders. And it can be also used to gather information that is required for this BE reporting, such as race, gender, disability status, and so forth. So it's a nice tool. It's aimed at retail shareholders, so it won't really help you where you've got institutional shareholders or other companies holding shares, but it certainly is useful in getting information from your retail shareholders. And it is more details are available on the JSE website if you search under Share Hub. I'm going to run another poll, and after the poll, I'm going to hand over to Trevor just to talk us through mandated investments and how one completes the compliance matrix for mandated investments. If you could select your favorite cartoon here and just make a note. Just now, Sean will run a poll. So he's going to run a poll saying either you like number 1, the toilet paper one, or number 2, the pajamas one, or number 3, the haircut one, or number 4, the back to school one. So select your favorite cartoon and we'll then just run a poll to see which one is the overall winner. Sean, can you just run that poll?
Sure thing, Eric. I'm going to run it now. So everyone should be able to see the poll now. Eric, I don't know if you want to go through the results.
Sean, I can't see them from my side, so if you go through it.
Okay, sure thing. So we've got a large majority of people liking number 2. 44% of people like number 2. 16% of people prefer option 1. 16 prefer option 3, and 24% of attendees prefer cartoon 4. Those numbers are still changing slightly, but number 2 is definitely our winner. Thanks, Eric.
That's quite interesting. We ran this poll internally within Alternative Prosperity, and number 2 also came out the winner, the pajamas one. My favorite is the haircut one for some reason. All right, I'm gonna just hand over to Trevor to walk us through the mandated investments. And Trevor, if you could just prompt me when I need to change slides for you.
Thank you, Eric, and hello, everybody. Even though we're not using our videos, I can assure everybody I'm not a subscriber to that pajamas cartoon, so I'm well dressed for the occasion. Nice to meet everybody. What I'm going to talk to very quickly is an introduction to mandated investments and what they are, etc. For those of you that don't know, just a little bit of a chat quickly about why they are important, particularly in the context of listed ownership, or why this particular category of ownership is important in the context of listed ownership, and then very briefly on the 13G requirements that Eric alluded to, and how this specifically impacts on mandated investments. Okay, so what are the categories of mandated investments? What you guys should see on your screen now is a list from the codes of what the various categories of mandated investments are. You'll see that there are, I think it is 7 categories of mandated investments on the list. By far, the 3 most important, however, are the 3 that are highlighted in green on the slide. So the first one is at the top of the slide is investments made for collective, in terms of the Collective Investment Schemes Control Act. So this is typically referred to in the financial services industries as investments through unit trusts, or otherwise internationally, this is referred to as investments through mutual funds. So that's the one category. The second one is investments through pension funds. The pension funds come in a variety of different categories, but the bulk of pension funds are what they call employer-sponsored, and many of you that work for major employers are members of these schemes. And this is and even out of those 3, that is the biggest of the 3 categories. The third very important category is life insurance policyholder funds. So in other words, life insurers invest in 2 contexts. They invest as shareholders themselves, but they also invest out of policyholder funds in listed companies. And those are the 3 most important categories in the codes. Just to touch on the balance of the categories just for a second. Medical schemes is probably, to give you guys an idea, roughly 95% of all mandated investments tend to fall in these categories. The next category is probably medical schemes would be the next biggest, or as I say, not particularly big, but would be the next biggest. And medical, because they're allowed to invest in equities. Banks would tend to be players in the debt space rather than the equity space, so they are very, very small in the context of mandated investments. What is quite interesting about understanding mandated investments as well is there's significant overlap between beneficial ownership of mandated investments. So, for instance, a lot of mandated investment that you see on company share registered has been in the hands of collective investment schemes or unit trusts come via the life insurance route, for example, via what they call unit-linked life insurance. Some retirement fund money follows that sort of thing as well, etc. So there's a lot of overlap in terms of understanding where the beneficial ownership of mandated investments sits in the code. Okay, so give you guys an idea. So why is it important, mandated investments? So it is one of these things that over the years has been a little bit controversial. So some people say that mandated investments are very, very important simply by virtue of the fact that it gives you an idea of broad-based participation in South Africa's biggest companies. Because to give you an idea, just the pension fund industry, the estimates are that about 16 million people are part of the pension fund industry in one way or another. So that's the one aspect. Other people say participation through mandated investment schemes gives you an idea of the level of financial inclusion in the financial services industry. That might be a valid point as well. But and then there's a third school of thought that says that it's not really real ownership, that it's ownership that listed companies achieve almost by default. Be that as it may, whatever your particular views on this particular matter are, is mandated investors are the single largest category of shareholders in most listed companies. So I've given you a rough rule of thumb here around some averages that we tend to typically see on listed share registers. On the left-hand column, we've got what we call the local register. So if you look at companies registered, and I'll stick to the JSE for the time being, in South Africa, the vast bulk of companies that are registered and that are listed on the JSE have one listing. They have a listing in South Africa on the JSE. Some companies have got small secondary listings on other exchanges in places like Namibia and various other places. And then some of the biggest companies listed on the JSE are actually what we call inward listed, and their main registers are global registers in places like London and Luxembourg and so on and so forth. So if we look at the first category of investors, which is of listed companies, which is these predominantly locally domiciled companies, and with the major listing being in South Africa. Typically, South African mandated investors comprise about 40% of the register on average, which is perhaps a coincidence, or it was the case, I think, way back in 2006 when the threshold for exclusion was debated. Within the generic codes framework, and that hasn't really changed much over time. Foreign investors typically in these sorts of companies are roughly the same level. They just are incidentally also generally mandated investors, things like pension funds and so on, and mutual funds overseas. But obviously they don't qualify as mandated investment in terms of our legislation because they are foreign. But it's just for interest. It's interesting to note that these are generally not wealthy foreign individuals investing on our exchange. They're mainly also institutional investors. And then the last category is all other investors put together, more or less, is in general around 20%. So this would be a combination of your BEE schemes, your individuals, or what, as Eric referred to earlier in this presentation, as retail investors, etc., etc. The situation looks somewhat different in what we call inward listed companies. That's the term that is often used. These are typically companies that have their primary operations overseas as well as their primary listings overseas. Typically, SA mandated investors, because the South African float on the JSE tends to be quite small relative to the global market capitalization of the company, tend to have a smaller stake in those sorts of businesses. And because the The larger float tends to be on a foreign exchange. Foreign investors tend to be the bulk of the owners of those sorts of companies, and other local investors tend to be quite small and predominantly invest through the JSE. So there's a very different dynamic in your so-called inward listed companies versus your listed companies that actually have their primary shareholding on the JSE. So if we could now just focus a little bit very quickly on the current reporting requirements for the Commissioner. So just to position this a little bit further from what Eric said earlier, the Commission has been asking for this kind of information for quite some time now, and this started probably around 18 months ago with some of our clients, where the Commission was asking for this information around not just mandated investments, but as Eric was alluding to, around ownership in general. And initially, there was a big debate around whether this information was actually necessary, because a lot of this information does not impact on the rating, and so on and so forth. And what we've done over time is we've tried to encourage most of our clients to work with the Commissioner. I think we have a lot of understanding of the Commissioner's need to collect information at a more granular level in order to, as Eric was alluding to earlier, to be able to report more holistically on how transformation has progressed in South Africa. So even in our own solution, we did an extensive amount of additional work during the course of last year in order to assist with this particular process. So even though a lot of this information is not necessarily a legislative requirement, so gender is a legislative requirement, but for instance, underlying, as we all know, the underlying split between African coloureds and Indians isn't necessarily a legislative requirement, neither is the location. However, what we've managed to do in our particular situation is we have now managed to actually, by and large, split the bulk of the institutional holdings, black institutional holdings that we identified by province, by gender, by underlying racial qualifications, etc. The two categories of ownership, the two categories that the Commission requests that we ourselves don't provide information on are the age issue and the disability. This is simply because the only potential areas where this plays a role in terms of the ownership scorecard that Eric spoke to earlier is in the designated group space. And in our particular solution, we don't provide any points for designated groups, and the Commissioner's note on this particular issue therefore allows you to actually put a 0 against those where you are actually not claiming points across the scorecard. So the bottom line, I think my message is it is possible through mandated investments to meet the Commissioner's requirements. These requirements are generally expressed in terms of value of participation, split up between these particular groups, etc., etc. Eric, that's me. Thank you.
All right, thanks, Trevor. If we could just run through some questions and answers. I'm not sure, Adolf, if there are a number of questions that have been posted on the Q&A. Between me and Anton, we can address them.
Eric, no questions so far. So you'll be welcome to just go ahead, proceed as normal.
All right. I'm going to hand over to Anton van Geest, and Anton will take us through the net value in a nutshell, or in a simplistic explanation of that, and then also talk through how COVID-19 impacts on the scorecard. So Anton, if you could run your slides.
Sorry, Eric, if I can interject, we do have one question that's come through. Please explain the importance of mandated investments. So if Trevor or Eric, if you could answer that.
Okay, if I could answer that. Just with mandated investments, with a listed company, as Trevor showed there, on average, 40% of a listed company's shareholding is made up of mandated investments, largely collective investment schemes, also largely, if we look at the pension fund shareholding, and then life office policyholder funds. So by analyzing your mandated investments and estimating the black ownership that arises from mandated investments, a company can increase their black shareholding to a large extent, because you've got the option of either including mandated investments in your ownership calculation or excluding those mandated investments to a maximum of 40%. When these mandated investments are included, you can also apply the modified flow-through in the ownership calculation. And hence, it is very important to analyze and evaluate whether you have sufficient black ownership in mandated investments that would validate the inclusion of these mandated investments in your ownership scorecard. So I hope that clarified the answer.
Thank you very much, Eric. We've got two more questions that have come through. The second one being, question to Trevor: how do you navigate the difficulty of obtaining the ACI and the provincial BEE data for commission reporting? Trevor, if you don't mind, just in what Eric.
So yes, I'm happy to take that question. It was a severe challenge initially, is the answer to my question. But it is possible to do in the context of value. Just understand a large chunk of mandated investments actually comes from pension funds. And pension funds are largely a reflection of employment in South Africa, in the formal sector. And you do get, so some of it is possible to do via, parts of this is possible to do via employment equity reporting. So that is fairly granular, and a lot of information is available from the Department of Labour, not just what they publish, but you can request information from them as well, which we do, and we do a heck of a lot of that, those sorts of analysis. We then correlate that analysis back to our underlying research, the research base that we've always had on mandated investments. So we use a combination of public, semi-public, and other information that we've obtained over the years from mandated investments. So the answer to the question in a very long way is, it is possible to do, but it is not without its challenges.
Great. Thank you, Trevor, so much for that. Just one more question, not addressed to anyone specifically. It is the shareholding through trusts now acceptable to the commissioner? Has it been formalized?
Okay, so there was recently the Minister of Trade and Industry went to press saying that these schemes or some of these schemes are eligible. And we understand that there is a piece of legislation that is in the pipeline. We were expecting that it may be published on the 1st of April, but it didn't come through. And we understand there is further work being done on that. So nothing has changed in terms of legislation. And it's been the BEE Commissioner's interpretation on certain matters on these trusts that have been, let's say, problematic, and where they also investigated or threatened to investigate certain trusts. So number one, the law never changed. Number two, the BEE Commission's interpretations on some of these trusts became a problem for companies. And number three, we believe there is something in the pipeline that will be clarifying and setting a few things straight around the trusts. We're not sure when that will come out, but as with all this kind of legislation, it could be a couple of months away.
Eric, if I may just add, if you don't mind, can you hear me?
Yes, please.
Yeah, the minister was, I'm not sure if everybody saw this, but the minister was also in the media quite strongly to say that trusts remain a legitimate mechanism through which broad-based schemes and trusts remain a legitimate mechanism through which ownership targets and so on can be addressed. So I think that's and that's very much part of what Eric was actually talking about. So I think watch the space. It should be resolved fairly shortly.
All right, thank you, everyone.
Sean, I do think there's some more questions coming in. Maybe just probably address one or two extras.
All right, Anta, no problem. Let's have a look. Okay, we've got another question. So it says, good day, my question is on mandated investment. Will you be able to obtain region and race per demographics and not just black and if disabled?
The answer is yes. We have got region and race, but we don't provide information on disability. That's the answer.
All right, thanks, Trevor. And then the last one we've got you for now is any idea on the issuing of a notice regarding targets relief permitted, target/relief permitted as a result of COVID? Indicated this was with the minister early this year, but nothing has been published to my knowledge. So
yeah, we're not aware of any, or there's been no relief arising from COVID. So my understanding of the question was, has there been any relaxation of targets or requirements following on COVID, okay, on the BE scorecard? The only areas were around the financial sector code on the consumer education, where there was a relaxation on the type of consumer education that is required. And but other than that, there was none. There was the holiday on SDL. I think it was April, May, June, July, 4-month SDL payment holiday. But that did not flow through to the skills development target. So the BE code still require that you take the deemed SDL that should have been paid for those months, and you still calculate your skills development target on that. So in short, there's been no real relief from a BE point of view because of COVID.
Eric, again, if I can probably add to that, my understanding is some of the business organizations did engage with the DTI on that. And as you correctly point out, there's nothing come through. There was also questions from a lot of the corporates as to whether donations to the Solidarity Fund in the context of COVID could qualify somehow for the scorecard, etc. And that was clarified by the Commissioner. The answer is in essence no. Yeah.
all right, thank you, Trevor and Eric. Just a housekeeping question. Will you be able to share the presentation? So just to inform everybody, we will be distributing the presentation and recording post-webinar. Another question has just come in. It says, hi, is there some dispute with people? There is some dispute with people noise. Can we request that they put silent? Okay, no, that's fine. We'll ensure that people that aren't presenting are on silent. Thanks for that.
Okay, thank you, Sean. Thanks, colleagues, Eric and Trevor, and for your contribution. To everyone attending, it's great to be part of this presentation, and I hope that in the next section I will be able to simplify a matter that is sometimes referred to as one of the more complex areas of the scorecard and the ownership element very specifically. I do think, you know, unpacking ownership structures, especially with multi-tiered type of structures, it becomes quite a nightmare sometimes to understand what is the real black ownership flowing through into a typical entity. And the net value just adds on top of that. So it's my task actually today to try and simplify this for you to the best of my ability. Your questions is welcome, and we will cover that at the end. I want to start with a poll actually, and the question that I have is to understand where you are actually on understanding ownership and net value. So have you been exposed to the concept of net value on the ownership scorecard previously? And there's three options: either no, I had limited exposure, or yes. So Sean, if you can run that poll for us, please.
Thank you, Anton. So we're running the poll in the background. So far, the majority, 53%, have voted yes. 29% have voted limited exposure, and we've got 16%, which is now 20%, that have voted no. So I'm going to quickly make those results visible to the attendees. And I think you can proceed when you're ready, Anton.
Thank you, Sean. Yeah, thanks for the indication. So we have quite a mixed component of people actually not knowing anything about this, to some people that have been exposed to a large extent actually, and I think it also speaks to the attendees actually, which names I've recognized actually in the list. So starting off with ownership and with net value and all of that, I think we have to go back one step and thinking about the mechanism of buying a house. So when you buy a house, there will obviously be some sort of price tag that you have to pay actually for this house. This will mean actually that you will have to find some funds. So very specifically, either through savings, or it can be through some borrowings from a bank or a private person or whoever you will lend you that money. So that is the primary mechanism of buying any asset. And thinking about that, that will give you certain rights. That will give you the right actually to live in that house, maybe the property to rent out later on, whatever you want to do with that property and what is allowed, what you are eligible to do with that property. I still remember the first time I bought a house, although I owed a lot of money on that, I had the right to do anything with that property in terms of making my lifestyle better. Now putting that analogy through to acquiring a shareholding in a business, it is nothing really different when you buy a share in the business. There's still going to be a price tag to that. And that price tag is going to be based actually on certain valuations, as you have a valuation with a house. And that funding or that pricing needs to be paid for either through savings again. So it could be that a mandate investor actually pay that, or you go and borrow some funds actually either internally from the company itself. It could be that you buy or borrow the shares actually, or borrow the funds actually from someone else, actually an external party, which can be a bank, etc. as well. So all of this actually also, that asset gives you a right to that shareholding. And as Eric actually also started to explain, the rights that you have to a property or to a shareholding is based on three different mechanisms in the BEE codes, in the financial in the ownership scorecard. Firstly, linking to the voting right. So when I have a share in a business, I will have the right to vote on an AGM at least. I will have to be able to decide actually who are the board of directors of the company. Secondly, I would think about the dividend component of that. So when there are any dividend distributions or profit distributions, I will be able to get my portion of my profits actually through a flow of dividends typically. And then also, very importantly, if I have a share in a business, there's equity, there's value in that. I paid something for it, and when I sell it, I would want to have at least, hopefully, a return on the business. Obviously, it's not an ideal world. We're living in different times, so values fluctuate all the time. So very specifically, the equity value is very much of an important area in the codes. Actually, in the ownership element, it's quite an important area of that. Also thinking of what Eric started off with, what is the objectives of the B Act? And part of the objectives of the B Act is actually for Black people to own and to own shareholding, and also to create wealth. To distribute is about distribution also of wealth at the end of the day. So equity value, apart from the other two, which is also quite important, equity value is mostly the driver, I would say, in what we will have as a long-term involvement and so on in the company. So looking at focusing now into the BE scorecard as such. If we look at the BE scorecard, firstly, Eric also pointed out that 25% out of the total points on the generic scorecard, and that also applies to all of the sector codes, it has a very specific weighting point allocated, is allocated towards the ownership element. Unpacking that ownership element, as I explained, 3 areas which is measured: voting rights, the economic interest, which is the dividend rights actually, and then also the net equity interest, as it refers to in the codes, also called the net value. Different ways of different words that's used for this is also measured, and you can see actually on the net equity interest or the net value component, 8 out of the 25 points, quite a significant portion, is actually allocated towards this net value measurement. So the value that is in the hands of black shareholders. Thinking about now and going into the net value that is held by a black shareholder and how it is measured, thinking about the word of net value. Obviously, it's actually indicative that you have the word net included in that, and then also value. So unpacking that, you would obviously take into account the value of the shareholding minus any outstanding acquisition debt, or any, let's just talk generally, any outstanding debts attached to that shareholding and to that value of that shareholding. And that would end up as your net value component in very basic terms. So measuring that now becomes a little bit of a different exercise, and that is what we will unpack in the next few slides. Just actually thinking about it, and what is the issue with this net value component of the scorecard? If you go back in the codes, and also explained earlier, some elements are prioritized in the codes, which means that you need to achieve a sub-minimum score on those prioritized elements. Otherwise, whatever level you will achieve based on your score that you achieved on your scorecard, you will be discounted 1 level on that scorecard. So it might mean that you achieve a level 4, but then being discounted to a level 5, or actually just get on the scorecard on the level 8 and then being thrown down to a non-compliancy level again. Ownership is one of those elements, and very specifically, the net value component is very specifically targeted to be the sub-minimum factor for discounting on the priority element status. So not so much actually the percentage of black shareholding that you have, or the points, the total points that you have on your scorecard, but rather the value that has been created in the hands of black shareholders. reading what the generic amended generic code stating is the sub minimum requirement for ownership is 40% of net value, meaning 40% of the 8 points. So that means 3.20 points that you have to achieve based on the time-based graduation factor as provided in Annexure 100E. So unpacking all of this is what we're gonna do now. So thinking about moving into the net value components, actually, what is your net value components that contributes to the calculation of the net value number and the net value score at the end of the day? Firstly, as I explained earlier or mentioned earlier, there's a value of shareholding that we need to determine. Secondly, we have the outstanding acquisition debts that we have to determine. Moving further in this value of shareholding, this will be determined based on the percentage of shareholding that you have, multiplied by, and that's percentage shareholding is based on your economic interest shareholding. You might recall actually on the scorecard, we distinguish between voting rights, economic interest, and then the net value component. Voting rights measure the ability of black shareholders to exercise its right to vote on an AGM. Economic interest measures the right of any dividend and profit distributions, also referring to as the return on ownership in the definition of economic interest. It is that component, that economic interest component, which is used for the calculation of your value of shareholding. Having said that, that is the simplified route. It might be a little bit more complex when you run real calculations, especially complex type of instruments that contributes to the ownership and to the value of the business. That could all have an impact actually on how this percentage of shareholding is calculated. The other component of the value of shareholding is the value of the business. So you have a share in the business, and that is based on a very specific value of what you have in this business. So if XYZ is valued at R1 million and you have a 10% shareholding in that, then your proportionate component would be R100,000 in this example. It could be different actually based on some minority shareholding basis, etc., but that is how I would almost say a science on its own is the valuation methodology. Fact is, you need to apply the value of the business in your calculation of the value of the shareholding. And that valuation methodology is also described in the verification methodology, referring to the verification manual, which was promulgated back in 2008, just after we've seen the first generic codes in 2007. And reading through that, it is not just a normal quick calculation actually that you can do on your valuation, on the valuation of this. There needs to be more professional involvement in that. For a listed entity, it's a little bit different because you trade your shares on a daily basis. It's listed on a stock exchange board, and you have a price tag to that, which serves as the valuation of the company, also referring to the market capitalization of the company, etc. But your valuation is essentially should take into account the professional person evaluating the business or the shares. You need to ensure that evaluator should be objective. Actually, your source data is of extreme importance. Actually, in this regard, and also what type of assumptions and methods you are using, because it's not only one method that you use for calculating and valuing a share. At the end of the day, you need to take careful consideration for what you get to as the fair value of that very specific instrument. And it cannot just be the so-called back of a cigarette box type of calculation that you can do. Moving into the outstanding debt component. And that component actually is also defined in the code. Now, thinking about debt, there's a lot of debt that you might have on your balance sheet. You might owe debt to the bank on your car, on your house. It might be private debt that you have incurred actually. But then you might also have this shareholding in the business, and there is very specific borrowings linked to that shareholding. This is what the BBEE code is including in your net value, and it might become quite grey later on to say what is the real debt attached to my shareholding. Fortunately, the BBEE codes define what is acquisition debt, and reading the definition, it means the debts of black participants in terms of the codes incurred in financing their purchase of their equity instruments in the measured entity. And then it goes on actually with heuristic and persons and trusts actually, which follows the same route. So essentially, what your acquisition debt is, and the way we measure that when we calculate the net value, is the financing that was provided to purchase this share, and which has a type of a right of attachment to that share. There could be some sort of collateral on that. There could be some sort of security that you have put through your shares actually on that. So your acquisition debt is a very key component of measuring and calculating your net value. And you might fall easily into a trap when you calculate the net value, not to ask the question whether there are any acquisition debt attached to that shareholding. So when calculating, make sure that you have that acquisition debt being asked for, and that you have the correct value and the accurate value of the acquisition debt being included. The acquisition debt might be as easy as getting a statement from the financier. It could be working through various components of a subscription agreement and so on, where you have to calculate and determine whether there are any imposed type of acquisition debts, as I've seen lately in an agreement. Stopping there for a moment, and I hope you all are still awake. I want to run a next poll actually, and asking the question, in your opinion, what would you regard as the most important measure of black ownership? Would it be voting rights, net value, economic interest, or are you in a few minds on that? So Sean, if you can run that.
Thank you, Anton. That poll is currently running. Just to take you through the results as it stands now, we've got 15% of our attendees, now 17% voting rights, as indicated voting rights is most important. We've got 40% say net value, 40% say economic interest, and 2% say I'm not sure. Just to give you an update, okay, well, these numbers are fluctuating. I'm going to just publish the results for everyone to see. But it seems to be 40% for net value and 40% for economic interest as a tiebreaker there.
Thank you, Sean. It's quite interesting. Yes, and it's all about the monetary terms at the end of the day. Net value, economic interest drives some to some extent the value of a business, having rights to dividends, etc. Control is another mechanism actually that you use through voting rights, which is not necessarily always valued. And there's been quite a lot written about this. The ability that you have a vote. What is the price tag for having the control in a business? Moving forward into this calculation of net value, we sit with two formulas to calculate. Now, those of you that indicated you had some limited exposure, or you've been quite well exposed to this, it would not sound like a Greek translation of net value into formulas. For those that haven't been exposed, all of this net value, this numbers that I've just calculated, is translated now into points, and it must follow a route to get to some points. So just in short, high level, firstly, what is this Formula A and Formula B? And as I said, this is the formulas that is applicable to calculating the points on the scorecard to get to the ultimate 8 points, hopefully on your scorecard. It goes further and say, for these two formulas, you will get two answers. Sometimes it will be different answers. And those two answers, you should apply the lower points of these two formulas in your net value score. So it would be, I would contextualize it a little bit later. Firstly, your Formula A measures what we refer to as the deemed net value. This numbers that we have calculated now, taking into account your value minus your acquisition debt, and base that on a target, which is then calculated based on time-based graduation factors. So nothing else from, this Formula A is nothing else from taking this deemed net value that you have achieved, express that as a percentage of your total value of your business, and then measure that percentage, that deemed net value percentage that you achieve against a target, which is informed by the age of your transaction, whether it's 1 year, 2 year, 5 years old, or 10 years old. The other component, the Formula B component, I normally refer to as the limiter in this case. The reason for that is that it measures the net value points based on what you have achieved on your economic interest component. So if you report 20% on economic interest, your net value points will be based on the extent that you have achieved your your economic interest target. So essentially, you might end up with Formula A achieving the full target and the full points, but because you haven't achieved the full target on economic interest, you will be limited in terms of the points that you can recognize on the scorecard. So let's unpack a little bit more on the Formula A component of this net value indicator. There are two formulas that I want to discuss with you here. And unpacking this Formula A, it consists of two sub-formulas. Firstly, calculating, as I mentioned, the deemed net value component, which takes into account the value held by black participants, thinking about the value and the shareholding, etc. Deduct from that your acquisition debt, so getting to this net value number that the shareholder will have, and express that as a value of the measured enterprise. Now let's just make it a little bit more practical. I have a business, and I have a black shareholder with 25% shareholding in the business. This person still owes quite a lot of money against that shareholding. So the 25% shareholding gives the black shareholder the right to vote proportionally, 25% voting power in an AGM, Also, the black shareholder has the rights for receiving dividends when there are dividend payments being made. Also proportionally, 25% of the dividend that is distributed will be received by the black shareholder in this case. But when that black shareholder wants to cash in and sell the shares, 25% will not be realized in the hands of the 25% of the value will not be realized in the hands of the black shareholder. The reason is that there's still debt owed to that. So you might end up with 10% or 5% of the value of the shares actually to be realized. So that is what's essentially measured with a net value. You might have this disconnect between the economic interest, the voting rights, and then on the other side, the real value in the hands of the black shareholder. Formula 2 in this component now takes this deemed net value percentage that we have calculated and express that as a percentage of how close you got to the phased in or to the target. This target is linked to the economic interest component of your ownership scorecard. In this case, at the generic code, it will be 25%. This phasing in of the economic interest is quite interesting, realizing that when you buy a share in a business, you will not be able to repay all of the debts in 1 year. It will happen over time, and the B codes allowed for that. So based on this phasing in for the first 10 years of the code, there's been a target that the code set for each of those years that you need to achieve in order to express what is the real net value that you have created for the calculation of the points. So what the codes included was a phasing in target saying that in year 1, it is expected that 10% of this target of the 25% should be unencumbered, should be in the green as such. So that means 2.5% of your shareholding must be unencumbered black shareholding in order for you to get to your full points. In year 2, it would be 20%, so it means translated 5%. Year 3 and 4, 40% of the 25%, which means 10%. So it goes on until the first day of year 9 that you have to achieve 100% of the 25% target, which means 25% in this case. I've mentioned earlier that you need to achieve a sub-minimum for you not to drop a level on this net value scorecard. And translate these phased-in targets, these 2.5%, 5%, 10%, etc., into a sub-minimum for you to achieve a real bare minimum, which will translate in the appropriate number of points, not for you to drop on your ownership scorecard. That would translate into 40% of each of those targets. So if you're playing around with numbers, you would want to ensure that in year 1, at least 1% of the value, and not 2.5% for the full points, but 1% should be achieved. And so it goes on actually 2 out of the 5%, 4 out of the 10%, and it goes on actually. So the codes are very clear actually on how you calculate this time-based graduation calculation. And this is actually this is just a copy of the wording in the codes. So making it a little bit more graphically, if you think about a graph and you depict your ownership scorecard and your net value component on that, you would want to try to achieve anything between the blue line, which is your net value target to be achieved, which will give you your full points, and your red line, which is your sub-minimum, your sub-minimum score, that you have achieved. In this case, this company did not really change the net value, did not really move, so the green line was not a very good site for this company. So moving into Formula B, as I explained, that would be the limiting factor in your calculation. Formula B express what you have achieved on your economic interest held by black people as a percentage of your economic interest target, and express that then as the points at the end of the day. And that would then result in your Formula B calculation. If you end up with 8 points on both, obviously you will achieve 8 points. But what we see immediately, and something for you to remember, immediately when you have lower economic interest than the target on the ownership scorecard, you will never be able to achieve the full points on your net value component. Let's translate it a little bit further. If you have less than 40% of the target of 25% black shareholding in your business, then you would never achieve the sub-minimum. Remember that the sub-minimum is linked to 40% of the 8 points. So you need to achieve 3.2 points in this case. So 10% out of 25% will provide you with that 3.2 points. Less than 10% of economic interest will limit you in terms of what you will achieve, and you will be downgraded every time on your scorecard. So that is why there's sometimes a reference to have at least 10% of black shareholding in your business, if you don't want to drop a level. If we go further into the date on which this time-based graduation factor is based, and let's just go to that time-based graduation factor, this phasing in line actually, and referring to the wording very specifically on the wording referred to in the code's current equity interest date, the first year or the second year after that current equity interest date, that has been defined in the code. There has been an amendment about 18 months ago, which was welcomed by everyone. The reason is that this net value date or current equity interest date, as it's referred to, has been defined initially to state that it is the later date occurring on the commencement of the statement, which was 2007, or the date upon which the earliest of all store operative transactions undertaken by the measured entity to achieve the rights of ownership became effective and conditional. So if you have a range of black shareholding transactions, your time-based graduation factor target will be based on the oldest of the still existing transactions, which had quite a significant impact if you think of measuring net value on new larger transactions, or we wanted to top up on transactions, and suddenly you are now required to achieve a much bigger target on your net value calculation. What has changed in this? This wording, the underlined wording, the earliest of all store operative transactions have been removed, which means that each of these transactions can now be measured on their own, which has a much more positive effect on your net value calculation. Just use a quick calculation, an example. We sit with 3 transactions here, a 12-year-old transaction, a 5-year, and a 1-year new transaction. It ended up that after the latest transaction, the company got to 25% shareholding. So Formula B is not an issue anymore. But in terms of the old code or the old definition of this, translating all of these different calculations means that each of these transactions are measured at the oldest time-based graduation factor, which is post 10 years. So 25% is the target for that, which means that you achieve 2.88 points on your net value. Translated into your scorecard means drop a level on your scorecard. The amendment to this meant that each of these transactions are measured on its own, based on its own graduation criteria, and that 2.88 points then increased to 6.4 points, which is a much better reflection of the health of each of these transactions. So a welcome change in the codes on this. So in summary, when you measure the net value, your ownership is measured on different mechanisms: voting rights, economic interest, and net value. The net value, on the other side, serves as the priority element indicator. You must achieve, if you achieve below 40%, it will cause a default in your scorecard. And what this net value indicator essentially measures, as I mentioned, is the health of the black shareholding. And also, which is legislated and to some extent expected from the legislator, that the transactions should be what is the perceived health of a B transaction. Now, moving into a next phase would be to say, what is the real impact? And we've seen now with the last year, 12, 13 months on COVID, what happened in that in that year. And I think to some extent, as the economy picks up its head now again, we do see some of these case studies unfolding in calculations of net value. So I want to run you through a case study to help you to understand also the net value calculation, but also what is the effect, what could be the effect of COVID-19 in businesses. If we take an example, XYZ company has a black shareholder with 25% shareholding in the business. The details of this transaction is that the deal is in its 4th year. Secondly, the initial acquisition price was 1.5 million rands. The projected value, that was just, we've done this projection just before COVID hit, was 2.2 million. And by the way, I've done some of these projections just before COVID, not really thinking about COVID. And then it panned out to be a total different exercise, 6 months and down the line, and then 12 months down the line. So this is actually based on a real case scenario which I had. So the projected value at that stage was 2.2 million rands. The initial acquisition date was 1.4, and the projected value of acquisition date was 1.3. So running the calculations would have been one thing. The terms of this transaction was that the debt is paid off through dividends that is received by the black shareholder. And then what happened? COVID hit South Africa. And suddenly the company board decided not to pay any dividend because of cash retention and losses incurred in this year. So there was a lot of things happening. On the other side, that had an impact actually on the company valuation, and the company valuation dropped by about 30%. So what happened now on the net value score? Firstly, we still have the 25% on economic interest, so the rights to the dividends are still there. The rights to the voting rights are still there. But suddenly, our net value had a problem because we sit with a target that we need to achieve in terms of our net value, and we need to achieve at least 10% of unencumbered black shareholding, meaning 40% of the 25%. That is not the 40% for priority status, just happened to be now the same thing. In terms of this phased-in target, for year 3 and year 4, you have a 40% of the 25% target. If we translate now these formulas into real numbers, and let's calculate the deemed net value in this example. For the projection, we calculated that you will achieve 10.23% of net value, deemed net value achieved. Great, because if we go further and calculate the point, we would have exceeded that target of 10%, so 8 points it will be. So we were quite comfortable. When we have run the calculations 6 months down the line inside COVID, suddenly there's different numbers popping out. the value of the shares, which was projected to be 2.2, dropped to 1.54. The value of the company obviously dropped because as a result, and that is why the shares in the hands of the black shareholder dropped. On the acquisition debt, the debt actually increased. And the reason is that there was no dividends being paid. Dividends were used to repay the debt. So interest were added to that debt. So calculating this mechanism now meant that suddenly our value in the hand of shareholders dropped, our debt increased, and the value of the company dropped. So obviously a typical scenario which might have an impact on your net value, on your deemed net value calculation. So just stopping here, what would be then the movers and the moving factors on your net value calculation? Firstly, the value in the hands of the black shareholder, the value of the business, and the amount of debt. And as soon as you hear any of those three are moving, you will know that there's an impact on your net value component on your scorecard. It might well be that your company value is probably not changed so much, but because of certain limitations that there might be on the black shareholders transaction or some other factors, it could have a negative effect on the black shareholders transaction. And I've seen quite a few examples actually on limiting factors being built into the value of the black shareholder, sometimes perceived, but the fact of the matter is it has an impact. And if that shares is sold out in the open market, it might have a negative effect to the valuation of that shareholder's value. Coming back to this calculation, suddenly where we achieved a 10.23% of deemed net value, suddenly it dropped to 3%, just over 3%. So translate that into point. Suddenly we dropped from the full 8 points to about 2.46 points, which means that this company dropped a level based on this new valuation. What do we do in a case like this? And the question is, what can the company do? So going back just to this slide, you would want to, if you want to maintain your net value points, you cannot really do anything about the valuation of the business and the valuation of the shares. So the only place that you can move around would be with debt. And what some companies considered, and what I know what's been done previously, was to write off some of the debt, impair some of the debt, where it is possible, especially where you have a vendor finance type of transaction. So the measured entity has the control over that debt. It could be that either interest is withheld if it's allowed in terms of the terms. It could be that the value is written off. So obviously taking the hit for the measured entity through its income statement, and has a negative effect on profitability if it's not already in a loss situation. So there's a lot of issues that one needs to consider, and you need to take into account what will be the lower BE level have on your tradability and any public perceptions out there on your business. So it has a significant impact. So I think to some extent businesses are struggling to try and turn around a net value calculation. There are some remedies, as I mentioned, but one will have to look more strategically than just doing a quick exercise, which might bite the company later on and have a more even worse effect actually on the business later on. So I think for this, I want to move into any questions. Sean, if you can run with us just on any questions there might be.
Sure thing, Anton. Let's do that. All right. Okay, so sorry guys, just want to find the right question here. Okay. Can you please explain outstanding debt in a bit more detail? A lot of deals are vendor finance, but if a black shareholder pays upfront for their shares from money borrowed from a bank, does the loan from the bank count as debt in the calculation?
Good question. Thank you. That is a very gray area, I must admit. Our house view is that we only take into account acquisition debt and debt attached to that initial borrowing. If we go to the definition of acquisition debt, it very specifically refers to debt used to finance the transaction. Maybe I should just quickly go back to that slide and see. Let me just see where it is. Here it is. Okay, if you can see that, it's a debt by black participants incurred in financing their purchase of their equity instruments in the measured entity. So if there are any right of attachment against that shareholding, that would be seen as acquisition debt in this case. If you go now to the question asked, saying that I used some of my, not really, I would say savings, but I would use actually money borrowed from a bank, so like part of the facility on my house bond or something like that. Is that debt in terms of the acquisition debt term? I wouldn't say that, and this is not what the way we apply that. And the reason for that is that there's no direct attachment link to that shareholding through that debt. It is actually meaning that you used some of your savings, because you could have put your savings into your bond to reduce the interest in the long run, repay your bond quicker, that you used for buying now the shares in the business. So not necessarily it is debt attached to this shareholding, and that is why these type of borrowings will not be regarded as what we refer to as acquisition debt in this case. If the black shareholder later on go and encumber the shares through to use as security for a new deal, I wouldn't say that would either be acquisition debt in this case, because what was the initial finance and funding used for the shares? It wasn't borrowings at all. So I hope it answered that question.
All right, thank you very much, Anton. We've got a few questions to get through.
Yep.
So we've got another one here. When looking at Formula A of the NEI, how do we handle situations where company values change, but the debt outstanding does not calculate?
Okay, I think I explained that now a little bit in the COVID situation. I think, yeah, let's just see that.
Right. Continuing. Example, company is valued at 100 Rand in year one. They sell 10% to a black shareholder, and debt outstanding in year one is 10 Rand, 100% of black value. In year two, no repayments are made. However, company is now revalued at 200 Rand for performance. The black shareholding is now valued at 20 Rand. Debt remains at 10 Rand. Formula A company will still meet the sub minimum.
Yes, correct. Yeah. Very much so. So in this case, your value on your deemed net value calculation will go up from 10 rands to 20 rands, but your debt remained the same. So there is an increase on your deemed net value, which will definitely increase the net value calculation. in case of a 10% transaction, you would have either achieved or not, depends on the value and so on. You would have achieved the sub minimum at least, and then suddenly in year 2 your value doubled. So it would have the proportion between your value in the hands of the shareholder minus any of the outstanding debt would have increased. So that will definitely have an increasing effect on your deemed net value calculation and then translate into better points.
Thanks, Anton. Next question. What happens if your company does not declare and issue dividends? Would the economic interest be null?
No. The economic interest will not be null. And the reason is that your economic interest is not measured based on the actual payment of dividend and the amount of the dividend, but it's linked to the right of the shareholder to receive a dividend when distributions are made. That is normally included in the MOI of the company, and it's a right attached to that shareholder. The fact that there is no dividends being paid is a different decision, and interestingly, an indirect decision from the black shareholder as well, because the black shareholder is part of the shareholders meeting who appoints the directors of the company through its voting rights component. But a short answer, no. I've seen in very few cases where there were a measurement being done through calculating your economic interest based on the dividends being paid, and that was purely based on the agreement that was agreed with a black shareholder and with all the other shareholders in that case. So where the economic interest or the voting rights actually had a very specific right based on what the profit distribution will be at the time, but that is really rare in what I've seen.
Great, thanks, Anton. Next one is addressed specifically to you. There's always the vexing question about acquisition debt. If the black shareholder arranges his or her finance privately, private banker or personal friend, and there are no third-party rights on the shares, would you regard this as acquisition debt? Question. How will you know if the black shareholder doesn't declare?
Yeah. I totally agree, Dumisani. With this, it's a difficult situation. If it's a privately financed type of agreement, or there's just no rights attached, no third party rights attached to that. Fact of the matter is still, if I refer back to the definition of acquisition debt, was it finance that was incurred when acquiring the shares, regardless of whether there's a third party right or not? And that is the question to be answered. So what can you do? What if the black shareholder doesn't declare that? Well, the measured entity is required to provide the correct information for verification purposes, and if not, they might be accused of misrepresentation, and in worst cases actually as fronting. So in this case, what do? What is the recourse actually for you as a measured entity? If the black shareholder doesn't declare that, there would definitely be some recourse by the measured entity to the black shareholder if that is not disclosed. It's more of a legal matter at the end of the day.
Great. Next question. On the graduation factor, is the period of 10 years determined from the date of your specific transaction?
Yes, correct. Yes.
All right. When applying the discounting principle, on which net value formula A or B is the discounting principle applied to as your referred to time-based graduation factor at the beginning of the presentation. I'll reread that. When applying the discounting principle on which net value formula A or B is the discounting principle applied to as your referred to time-based graduation factor at the beginning of the presentation, TBGF is the only applied on formula A and not B. So the question is, on which formula do you apply the discounting principle?
The discounting principle is applied on the final points that you have calculated in both formula A and formula B. And the codes require you to use the lower of formula A and formula B's points, on which you then use the measurement for the priority element, the discounting principle. So a discounting principle very specifically refers to 40% of the 8 points, meaning 3.22 points. Now, going back, how do you get to the points? Is through formula A, running through the whole deemed net value calculation, and then applying the correct time-based graduation factor, and getting to the appropriate points, and then use formula B to see whether there are any limitation applied to it, and through the lower of those 2 points will be used for your net value, which will then determine whether you are above or below the 3.20 points. It might well be that you sit with a 10% B transaction, and in year 1 you have achieved, and there's no, or let's say there's no debt to that share. So it means that you have 10% you have unencumbered black shareholding in year 1, and it actually it does exceed your target for year 1. Now, thinking about that phasing target, you must have achieved 10% of the target of 25% to achieve the full point. So it's 2.5%. So thinking about 10% as the unencumbered black shareholding divided by 2.5, you exceed that by 4 times. So you get your full 8 points in formula A. But formula B applies a limitation to that. You only got 10% out of the 25% target of economic interest. So getting to 3.2 points in that calculation. So you have to apply the lower of the 2. So you will only be able to apply 3.2 points on your ownership scorecard, although formula A allows you to get to 8 points. But that is why there's a limitation included in this. I hope that makes it clear, Stanley. Sean, if I have access, I have now access to the questions. There's a follow-on question from Stanley. Maybe I can just read that. Would it not be important to identify the valuation method used in determining the value of the entity at the date of the transaction, as this would be linked to the relevant debt associated to the new black shareholder? Otherwise, the net value points would be skewed if most people only apply net asset value or nominal value as a standard value of the business at the date of the verification takes place. Yes, it is important to identify the valuation method when determining the value of the entity, and especially if the debt is also valued, one needs to take that into account. It is very important, but also take guidance from the verification manual, which very specifically requires the verification agency to apply due process, looking at the objectivity, the methodology, the assumptions, the professional competence of the valuator, etc. Actually, in that. Leading from this previous question, a follow-on question on that, stating that the valuation method would be crucial to determine the value in the hands of the black shareholder at the date of the verification, to determine the current debt associated with the shareholder based on the current value of the entity at the end of the verification. Therefore, the valuation method used at the date of the transaction versus each year of the verification would need to be consistent and reasonable. And the reason given if you changed, agree or disagree. I totally agree with you. You need to be consistent in this regard. And the valuation of a business would normally be based on a certain methodology and certain mechanism. You cannot change it. This year the NAV would be better than the discounted cash flow, for instance, and next year you use some sort of other mechanism just to get to a better value. There needs to be consistency. The problem that we do sit with is when you move from verification to verification agency, and there's no real record of the previous verification for the verification agency to do. But that is professional work that needs to be done by the verification agency as well. But I do agree that there should be some consistency in terms of the valuation methodology to be applied. I think there's 2 or so more questions. The next question: is the net value calculated as at the end of the financial year period or at the time of the B verification? E.g., the financial year end is 28 February, but the company is verified in August. Do you use the business valuation as per the annual financial statements, or do you perform valuation at the time of the verification? Good question. Your ownership is normally measured as close as possible to the date of measurement. So that means that you have to measure your black ownership percentages at a certain date, and if it's quite long after the year end passed, it would be required by the verification agency to have a later calculation being done. You might end up with a decision with a case where you still had 25% black shareholding as at 28 Feb. In August, the black shareholder exited, and you don't have the 25% black shareholding at that stage. So what do you do in that case? You cannot now put on your certificate that you have 25% black shareholding. It's not the real. It's not the truth. So in that case, you have to apply a later date, and that will also be applied to your net value calculation. Your net value calculation is a direct outflow of your real net black ownership of your business. It would be, however, for valuation purposes, it would be easier to use the financial statements data, but normally a valuation is done on the latest financial statements data, and then informed by any post balance sheet events, etc. So I think there's 2 more questions. The next one: if the target entity writes off a loan, say this year, can they reinstate the loan in the following year, assuming the company value improved? Difficult question, Israel. I wouldn't. There's a risk for me in this. You suddenly now write off the loan and tell the black shareholder that they don't owe this component of finance anymore, and then suddenly, when things are going well, you reinstate the loan. What did you achieve through that? You achieved through that initially that you achieved better points and on your scorecard, not dropping a level. And now suddenly, when things are going well, you reinstate the loan and penalize the black shareholder on that. So I would say there's a big risk for me of misrepresentation, even fronting, that could be imposed in this case. If you apply something, a mechanism like that, because the question would be: was it a real write-off of the loan, or was it just a mechanism to represent some different points on your scorecard? Then the last question: if dividends are being paid but are used to repay, if dividends are being paid but are used to repay the vendor loan, Does that affect the economic interest? No, it does not affect the economic interest, because the agreement initially with the black shareholder was that that they would use, and the financing agreement was normally that they would use dividends to repay the loan. How will you pay back the money? That is the question. And I will say, no, I will use my dividends to repay my loan. That does not take away the right that I have the dividends. I can decide what I want to do with the dividends, but I agree to use that as a repayment mechanism. So it does not affect the economic interest percentage on that. There's one more question, which is around the continued consequences principle. We are running out of time, but just in very short terms, what you achieve through continued consequence mechanism is that when a black shareholder exits the measured entity as a shareholder, in some cases, depending on on some requirements in the code, the measured entity are allowed to still apply the black shareholding as if that black shareholder is still a shareholder in the business. The intent of that was initially to provide the measured entity with a mechanism to still recognize black shareholding until they get to a stage where they have a new shareholder on board. So that is the basic principle of continued consequences.
Okay, thank you, Anton. Thanks very much for the comprehensive explanations on all of that. Thanks everybody for joining. Please, if you could just answer the feedback poll that Sean is going to be running, and we hope to see you at our next webinar. Thank you.
Thank you very much, everyone.